All right, welcome to Chapter 5. And Chapter 5 is, again, Chapter 4 started kind of the basic outline of the equation for figuring out not just taxable income, but also whether you owed taxes when you filed or whether you were going to get a refund, right? And so Chapter 5 is all about gross income. What's included in that top line of the calculation, right? And then, I guess just as important, maybe more important to us, what types of income are excluded from that calculation, okay? So Chapter 5 and Chapter 6 really start off the gaining of just a tremendous amount of detail. So as a result, I have decided I'm going to split this PowerPoint discussion into two parts. So this is part 1, okay, in an effort to kind of make these videos a little bit shorter. So we'll do like the first 7 slides here in part 1, and then there'll also be a part 2, right? So let's get rolling. All right, so gross income, all right? When we start talking about gross income, we have to talk about the difference between the realization of income and the recognition of income, okay? So remember that gross income is income from whatever source derived. That's what the tax code says, all right? It includes income realized in any form, whether in money, property, or services. So what that means is, if I do some tax consulting work for someone and I have a small farm and they pay me in chickens, all right, those chickens that they give me would be my income, even though it's not money, all right, it's not cash, all right, that certainly would be income if they paid me in cash, but chickens have an economic benefit, and so I would have to recognize income. So essentially, you have to recognize income when there is an economic benefit I'm going to make us some space here. There's an economic benefit. They realize the income. So income is realized, all right? And the tax law does not provide for an exclusion or a deferral. All right, so you have to recognize income when those 3 things happen. Now, I think it's very important to state that excluded income and deferred income, these are exceptions. Okay, the general rule is if you realize or recognize income, you are going to have a tax consequence to that, all right? All right, so what's included in gross income? Again, anything that gives you an economic benefit, okay? So lots of folks ask, well, I took out a loan. Is that income to me? No, that's not income. That's a liability, okay? So borrowed funds represent a liability, not gross income, okay? The realization principle, okay? If you engage in a transaction with another party and there's a measurable change in property rights, you have realized income, okay? So again, in my tax consulting barter example, where I traded tax consulting for chickens, all right, there was a transaction with another party. That transaction resulted in a measurable change in property rights, right? I now own some chickens, more chickens. I already owned chickens. And so I would have to realize income related to the value of those chickens. And then recognition. Realized income is assumed to be recognized absent any deferral or exclusion provisions. So let's talk about right now. I think the economic benefit part is easier to get your arms around. Let's talk about the difference between realizing and recognizing. All right, so let's assume I purchase a stock, okay? And let's just say, I'm going to make this bigger, that I purchase, whoops, I need to write more clearly here. Let's say I purchase IBM stock. And when I purchase it, we're just going to make this really clean. I purchase it on January 1 for $10, okay? And we're just going to assume that I purchased 1 share of stock, okay? Now, over the course of the year, IBM's doing great. This is, these past 2 years have been good for tech companies, especially if there's any kind of a virtual work from home kind of situation able to be done with their technology. So we'll say on December 31st, that stock and we'll give ourselves a pretty good growth rate. Our stock is worth $20. Okay, so as of December 31st, all right, on December 31st, what has happened? Okay, on December 31st, or as of December 31st, however you want to think about it, stock has appreciated $10, okay? What does that mean, okay? That means I have realized, right, an economic benefit of $10, okay? So this $10 is realized, okay, income. All right, now, what do we know about that though? If I choose to hold on to the stock, all right, if I choose to hold the stock, even though I've realized that $10 of growth, that $10 of income, all right, I don't have to recognize that, okay? So I have realized gain, but not recognized gain. Why? Well, remember that there is a deferral provision for that in the code, right? If I'm still holding on to the stock, I don't have to recognize that appreciation, all right? The recognition of the gain is deferred until you sell the stock, okay? So, as that stock appreciates, you have realized income, okay? But income related to the gain isn't recognized until the stock is sold. Okay? Now, there are a couple of other terms that we need to talk about, and so I'm going to scroll down and make a little bit more space. Okay? So, we need to talk about return of capital. And my stock example is a good time to talk about return of capital, because return of capital means that I am not taxed on my return of capital. All right. So remember, I bought the stock at $10. Okay. So this $10, that $10 is my basis. Right? Okay. And so if I were to sell that stock for $10 then, okay, it would not have gained anything, and my return of capital, my return of that original $10 investment would not be a taxable event. Okay? So that I would not have to worry about tax on return of capital. Okay? So this example uses dates of 2019 and 2020, but the concept is still the same regardless of the years involved. So I'm going to do this example problem in this video, and then in class we'll do one with current dates. Here we go. Okay, so let's talk about what's going on here. I'm going to resize this and give us a little bit of space. That's why I was quiet for a minute and let you read on your own. Okay, so what we have here, this situation, is an example of what's called the tax benefit rule. And what the tax benefit rule says is if you recognized a deduction or a deferral in 1 year that was more than you should have recognized. All right, so you received a tax benefit from it in year 1, and then it results in income or a return of funds in year 2, then that return of funds in year 2 is taxable. Okay? So if you received a tax benefit in year 1, that results in income in year 2, you must recognize income in year 2. Okay? Now, where this is especially prevalent is with medical expense reimbursement, or a situation like what we have here. All right, so let's talk about this situation. Okay, so we have a situation here with Courtney where she pays her Ohio State income taxes. Okay, and she had itemized deductions. All right, and she had itemized deductions of $20,100, okay? And that includes, okay, $3,500 of state income taxes, $2,500 of real estate taxes, and $8,000 of mortgage interest expense, and then she also had charitable contributions. Okay, so she was able to itemize. She files a state return and discovers that she only owes $3,080 in Ohio income tax for 2019. So she received a refund of her Ohio income tax. Okay? Under the tax benefit rule, what happens to that $420 refund? Okay? So, a couple of key things. Her itemized deductions. Look at her itemized deductions. They're larger than the standard deduction, because the standard deduction, remember, for someone who was single, all right, and this was 2019, and you have those numbers on your tax sheet. 2019 standard deduction was $12,200. All right, so we've already identified that she would have itemized on her federal return because her itemized deductions are larger than her standard deduction. Okay, so that's the first thing that we need to realize. We also have to remember that state income taxes paid up to a $10,000 threshold. Okay, I'm going to put that caveat in there. State income taxes paid are deductible on your federal return. Okay, so remember that within those $20,100 of itemized deductions, she had paid and deducted. So she deducted $3,500 of Ohio state taxes on her federal return. But what happened? Well, we got through the year, right? And what did she realize? She realized she gets a refund of $420 because when she did her state taxes, she realized that it turns out she only owed, I'm going to switch colors here, but only owed $3,080 of state taxes. All right. Now, how does that happen? Well, it happens to everybody, right? People do more tax planning for their federal return than they do for their state return. And so, obviously, if you're an employee, your company withholds state income taxes as well as federal income taxes. And then you fill out your state return along with your federal return. And lots of times you end up with a state refund. Okay. So what is the difference between what she deducted, right, and what she actually owed in state taxes once all the dust settled? Well, the difference is that $420, so that was a refund amount, okay? And so she received this refund in June of 2020. All right, so then when she's filling out her 2020 federal return that $420 is income on her 2020 return, okay? And so how did this happen? Well, a couple of things, okay? First of all, in order for this to happen, she has to itemize, okay? Because if she hadn't itemized, she'd get to take the standard deduction regardless of what her actual state income tax and real estate taxes and mortgage interest expense were, okay? And if this is a little bit difficult to wrap your brain around, don't worry, we're going to do an example of this in class, and I believe one of your homework problems for Chapter 5 has the tax benefit rule in it as well. Okay, so remember, if they are itemizing, then this is a potential issue, okay? And this is only an issue when you deduct something as an itemized deduction, and then you get a benefit from it. You get some of that money back in the following year, okay? This is most likely to happen with state income taxes, okay? Or with medical expense reimbursement. It happens very commonly there as well, okay? All right, so in general, when do you recognize income? Well, individual taxpayers, we file returns for a calendar year period, okay? Corporations, their fiscal year can end a variety of times. Lots of corporations are calendar year corporations, but your retail companies, for example, are going to have year ends in February because that whole Christmas season is their busy time, right? And so then they have to do inventory and all of that. So corporations can use a fiscal year end, and it can be whenever, whatever makes sense for their business model, okay? And then the method of accounting generally determines the calendar year end, okay, in which realized income is recognized and included, okay? So as we talk about accounting methods, let's talk about who uses what, all right? Corporations, and remember, when we talk about corporations, we should automatically kind of think about whenever we say corporation, there should be an implied, kind of parentheses, and we're talking about C corporations, okay? They typically use the accrual method of accounting. Individuals use the cash method, all right? And so really we have two judicial doctrines. All right, that help determine when we should recognize income. All right, and we've already talked about constructive receipt, okay? You're deemed to have received income, okay, when you have the ability to control that income, okay? So I'm going to expand and add when taxpayer has ability to control, okay? So constructive receipt is telling you you must recognize income if you have the ability to control it, okay? And so that is very different than claim of right, okay? Claim of right is giving you examples of times when you don't have to recognize the income, all right? So claim of right, also a judicial doctrine, says you don't have to recognize income until There are no restrictions on the use of income, okay? And so let me give you an example. So this is my favorite example for claim of right because it's one that most everybody can relate to. All right. So say you're going to rent an apartment. All right, and you have to pay the first month's rent and the last month's rent, and you have to pay a deposit. All right. So I'll write a little bit of this down. Claim of right example. Rent an apartment. So you're going to give your landlord too much rent and a deposit, and we're going to say your deposit is $500. Okay? So your landlord receives 2 months rent and $500 from a deposit. What income does your landlord recognize? All right. Well, you paid rent, okay? So the landlord is going to recognize rent income, right? But what about that deposit? All right? You just gave that landlord $500 of cash for your deposit. All right? And so that landlord has that $500 of cash. And as we've already talked about, individual taxpayers are cash basis taxpayers. So typically when you receive cash, right, that's an economic benefit, you have to recognize income related to that cash. Okay? But hold on. Claim of right says income is only recognized when there are no restrictions on the use of that income, meaning there's no obligation to repay that income. What happens with that deposit? All right, in the best of all possible worlds, you rent that apartment for however many months, your dog does not eat the kitchen, you decide you would like to find a better apartment, you get your deposit back, and you walk away having enjoyed your stay at this apartment, and you get your $500 deposit back. So had your landlord recognized income related to that $500 deposit, now when he gave you or she gave you that $500 deposit back, they would then have to recognize a deduction. Well, that doesn't make any sense. So claim of right says the deposit is not income until something happens and you lose the right to getting that deposit back. All right? If your dog eats the kitchen, now you're going to have to surrender that deposit, and that $500 deposit is now income to the landlord upon the day that the landlord discovers your dog has eaten the kitchen. Okay? So that deposit is not income unless the landlord doesn't have to return deposit to renter. All right. Another good example when claim of right comes into play is if we're talking about your bookstore, the bookstore on campus. All right. Everybody signs up for all these classes and you buy books related to all these classes. And then back in a time when we actually went to class. You go to class and you realize that you have registered for 5 classes and 3 of those are accounting classes, and you get into these 3 accounting classes and realize, holy cow, these accounting classes are a lot of work. And so you realize you don't want to take 3 accounting classes all at the same time, so you're going to drop one of those accounting classes. All right, well, what happens to that textbook? Well, you return that textbook. All right, so bookstores, automatically, they sell books, okay, and then they do not recognize income related to a percentage of those book sales until after the course drop date, because they know what students do. They know that students register for a bunch of classes because students think, okay, I'm going to knock all this out. I've got all this time. And then students get to their classes and realize, holy cow, I don't have all that time. And so in that span of time between when students register for class and when that initial drop day is, the bookstore knows there are going to be a lot of textbooks returned. Okay, and so from an industry perspective, university bookstores use claim of right to determine when they have to recognize income for all of those textbooks. Okay, so those are our 2 judicial doctrines that are very important to us in this chapter. Okay, and then the last slide for part 1 is going to be who recognizes the income. All right, types of income will be covered in part 2. All right, so who recognizes the income? So along with figuring out when income is realized and recognized, all right, we also have to recognize who pays, okay? Who recognizes the income, who has the tax burden, all right? And so again, we have a judicial doctrine, assignment of income, and we've talked about this before. All right, an assignment of income says, if I earn the money, I also earn the tax liability related to the money, okay? And then we also have this issue of community property states, okay? Community property states say that if you have a married couple, all right, all of the income, all right, is split. So, so half of the income and property held as community property is included in the gross income of each spouse. Okay. All right, so I'm going to write half of all income and property is included by each spouse. Okay? All right, so that is it for part 1. There will also be a part 2 for chapter 5, and I'll do part 1 and part 2 for chapter 6 as well, because otherwise they get quite lengthy. All right, thanks a lot.